call is now being recorded.
Good morning, friends. We are going to start from where we have stopped in the last session, and we are going to talk about some more information on income from the host property, and we are going to discuss about situation 1, 2, 3, 4. And in the last class, we have taken up situation 1, and now let's understand how to compute income from house property under various situations, situation 2, 3, and 4. So this is a situation 2. This is a situation 2. The situation that a property which actually occupied by the owner to the employment or business or profession carried out at any other section 3 subsection B. What does it mean? For example, Mr. A is there and he has a house property in Bangalore. Throughout the previous year 1920, that particular house property is not occupied by him and neither rented out because he's working in Mumbai or doing business in Mumbai. And hence, because of this reason, this particular circumstance has arisen. So, in this, please remember the 3 4 conditions which you should satisfy to claim that the person has, despite the fact that he has a property, he has not used property owning to the employment or business or profession carried out at any other place than the place at which he has his own house property. Condition number 1, the taxpayer owns a house property which cannot be actually occupied by him by reason of the fact that to his business profession carried out at any other place. 1. 2. Condition, he has to reside at the other place as mentioned in condition 1 in a building not owned by him. Number 3 condition, the property as mentioned above is not actually let out during the whole year or in part of the previous year. Condition 4, no other if it is house property by the owner. So these are conditions if the rules. Now, what is condition 1? The taxpayer owns a house property which cannot be actually occupied by him by reason of the fact that owning to his employment, business, or profession carried out at any other place. As I already told you, X is there having a house property in Bangalore and he's working in Pune. And the house property belonging to him in Bangalore is not occupied by him owning to the fact that he is doing job in Bombay or in Pune. And Pune and Bangalore are 2 different places. Condition 1. He has to reside at that other place as mentioned above in a building not owned by him. Now in Pune, he is residing in a house which is not owned by him. Number 2 condition. Number 3 condition. The above property, the aforementioned property is not actually let out during the whole year or any part of the year. This property which is there in Bangalore, which he has not occupied owning to the fact that he's owning to his employment because the property is not actually let out during the whole year or any part of the year. This particular property in Bangalore is not let out during the whole year or a part of the previous year. And condition 4 is no other property is derived from the no other benefit is derived from the property by the owner. Okay, if these 4 conditions are fulfilled, then if the above 4 conditions are fulfilled, then the income from the house property shall be determined as if the self property is self-occupied. If all the 4 conditions are satisfied, then in such a case, in such a scenario, it will be deemed that this particular house property is self-occupied and the gross annual property, as already discussed in the previous situation 1, the gross annual property of self-occupied house property is nil. Hope it is clear, crystal clear. Now, situation 2 is there, situation 3 now. Let's talk about situation 3. Situation 3 is when a part of the house property is self-occupied and a part is let out. Okay, so there is a house property like this. A part of this is self-occupied and this part is being let out. So there can be a circumstance like this also. If a house property consists of two or more independent, so these are all independent houses, residential units, one of which is self-occupied for his own residential purpose and the other units are let out. In such a case, let's compute income from house property. So these are the following steps. Unit self-occupied for residential purpose throughout the previous year, which is not let out to any other use. Let out units. Number three, unit self-occupied for the residential purpose for a part of the year lying vacant for remaining part because of is situated at the same other place. Okay, so unit self-occupied for residential purpose for a part of the year and lying vacant for remaining part of the year because of profession or employment is situated at some other place. So to understand this particular concept or situation three, let's take up a small numerical problem and solve the problem. And this demonstrates the way one has to calculate the income from house property, which partly occupied and partly it is rented out. So Mr. S. Ramesh Kumar Mehta owns a residential house property. It has equal residential units, Unit A and Unit B. For example, this is a house property. It has Unit A and Unit B. Unit A is self-occupied and Unit B is let out for a rent of 15,000 for the full year. 2 months is unrealized. So this particular house property, the other part is let out for a monthly rent for a rent of 15,000 for the full year. Okay, 15,000 for the full year, and out of this, 2 months salary is 2 months salary is not no, is not realized. So here, sorry, it's 1.5 lakh rupees. So 1.5 lakh rupees divided by 12 is equal to 12,500 rupees is per month rent, and out of which 12 months, 2 months are unrealized. Now, municipal value of the whole house property. Now, this whole house property, the data is given. The the municipal value of the house property is 2,40,000 for the full year. The fair rent of the full house property for whole house property is 1,80,000 for whole year. Standard rent for the whole property is 3,60,000 rupees. And this guy has let out this house property for 1.5 lakh rupees. Municipal taxes of the house property is paid rupees 18,000 for the full year and it is paid by the owner. Interest on loan borrowed for construction of the house property is 1,20,000 rupees and borrowed after 1/4/2009. Okay, so the rule is 1/4/1999. If it is borrowed for the purpose of construction of the house property, then a maximum of 2 lakh rupees is allowed. Let's do the problem. Now, in this case, there are the steps which you have to follow. Now, first we have to find out the income from the house property of the one which is self-occupied, that is Unit A. Unit A. I told you that the house property is of this kind, and this is A part and this is the B part. This property is self-occupied by him. As popularly told and understood in the previous session, a self-occupied house property has got a gross annual value of zero. So the same concept is also applied here because a self-occupied house property is not doesn't have any rent, neither it has eventually it doesn't have any gross annual value, and the gross annual value is zero. Municipal taxes paid by him, as I told, it's to be ignored, and this is zero. So 0 minus 0 will be 0, that is the net annual value is 0. Now standard deduction under section 24 of Income Tax Act 24A, standard deduction of 30% on NAV, which is 0. Now, as the house property is similar and 50% here and 50% here, as already mentioned in the problem that the house property is 50% of A and 50% of B, and for the whole house property, he is paying a interest on the whole construction of house property of 1,20,000 rupees. So 50% for this property house A and 60,000 rupees for the other house property B. So 60,000 will be allowed as interest on borrowed capital and 60,000 is shown. So 0 minus 60,000 is 60,000 rupees. So income from house property A, which is self-occupied, is generating a loss of 60,000 rupees. Now let's take up the second part of our house property, which is unit B, which is 50% of the whole house property. And let's calculate income from the house property. In this case, the municipal value of the whole house property is 2,40,000 rupees, and hence 50% belong of the municipal valuation is of unit B. The fair rental value of the whole house property A plus B is equal to 1,80,000 rupees, and hence 90,000 rupees is the fair value of house B. And standard rent of the whole house property is 3,60,000 rupees of A and B, and hence 1,80,000 is the standard rent of house property B. Now, the first step to be followed to find out the gross annual value is expected rent or reasonable expected rent. It is found out. It can be found out by using this particular methodology, which is municipal valuation versus fair rent, whichever is highest, which is 1,20,000 rupees. 1,20,000 versus 90,000, whichever is highest, which is 1,20,000. This has to be compared with 1,80,000 rupees, which is standard rate, and among them, whichever is lower, that is the reasonable expected rent, and that is 1,20,000 rupees. Now, the next step two is actual rent received or receivable is equal to the rent at which it has been let out minus unrealized rent. Unrealized rent. Actual rent at which it has been let out minus unrealized rent. So actual rent at which it has been let out is 1,50,000 rupees, and the loss due to unrealized rent is 2 months rent. And I told you that per month the rent is 12,500. 12,500 into 2 is equal to 25,000. So and therefore actual rent received or receivable is equal to annual rent minus unrealized rent, which is 1,50,000 minus 25,000 is equal to 1,25,000 rupees. So this is step 2. Step 3 is maximum of step 1, maximum of step 1, and maximum of step 2, which is 1,25,000 rupees. Vacancy rent. The house part B house is not vacant at any single point of time, and hence the vacancy loss due to vacancy is nil. So step 5 is step 4, 3 minus step 4, that is 1,25,000 minus nil is equal to 1,25,000 rupees. So you got income from house property of A is 60,000 rupees loss, and income from house property of unit B is 1,25,000 rupees. Now let's find out the gross annual after you have found out the gross annual value of the house property of B. Now we have to find out income from house property. So gross annual value of the house property is 1,25,000 rupees as far as B unit is concerned. Yes, municipal taxes. The whole house property, the municipal taxes were 18,000 rupees, which were paid by the owner. But as far as B is concerned, unit B is concerned, is 9,000 rupees, which will allow as deduction. Now, 1,25,000, which is the gross annual value, minus municipal taxes 9,000 rupees, you will get a net annual value of 1,16,000 rupees. 1,25,000 minus 9,000 rupees. Now, after that, you are allowed as a standard deduction under section 24 to the extent of 24A and 24B. The first standard deduction is The first deduction is standard deduction of 30% on NAV, that is 1,16,000 into 30 percentage is equal to 34,800. Now interest on borrowed capital. On the whole house property, he has paid an interest of 1,20,000, and for part B it is 60,000. So this is allowed as a deduction. This is allowed as a deduction from 1,16,000 rupees. So 1,16,000 rupees, 1,16,000 rupees minus 34,800 minus 60,000 will generate a income from sell from a let out house property, let out let out house property, of 21. Okay, small calculations mistakes here. Just I will rectify my calculations. Just a moment. So here 1,16,000, 1,16,000 minus 94,800, 94,800. So it is 2,000, 2,001. So this is income from let out house property, B, which is 21,200. So now, so from the first house property, that is A, from A there was a loss of 16,000, 60,000 rupees. From the other house property there was a profit of 21,000 rupees. So from the total house property, if you look and calculate, there is a loss to the extent of 38,000, 38,800. So this is the methodology or structure of answering the question as far as part of the house is self-occupied and part of the house is let out. So in this is the way you are going to tackle the problem. Next one is the fourth situation, a bit complicated situation, but there is a situation of this kind also. The fourth situation is when a house is self-occupied for a part of the year and let out for the other part of the year. For example, during the year 2019-20, which is consisting of 12 months, the first 6 months is self-occupied, the remaining 6 months it is let out. Or 5 months it is self-occupied, 7 months it is let out. Or 3 months it is self-occupied and 9 months it is it's let out. And in a kind of a situation, we have to find out the income from house property by using the following steps or by using the following rules. So in this situation, the benefit of section 23(2) is not available and income will be computed as if the property is let out. Section 23(2)(a) is nothing but self-occupied house property. Please remember it. So for self-occupied house property, the GAV is nil and NAV is nil, standard deduction is nil, but interest paid on the income from interest paid on the borrowed capital is allowed. But this is not allowed. This section doesn't is not enforced if a part of the year it is self-occupied and a part of the year it is let out, and it will be computed as if the property is let out. Now let's take a small problem and solve the problem, which will help us to understand how to calculate when a part of the year it is self-occupied and by the owner, and a part of the year it is let out. Let's solve the problem. So Mr. S. Ramesh Kumar Mehta possesses a house property, the details of which are given as follows. The municipal valuation of the whole house property, of the house property for the full year is 4,80,000 rupees. Fair rent is 4,20,000 rupees, and standard rent is 60,000, 6 lakh rupees. During the previous year, 2019-20, from 1st April 2019 till 31st, the house property was let out. Means 1st April, May, June, July, August, September, October, November, December. So 9 months it is let out and 3 months it is self-occupied. And when he is letting out, he has let out for a rent of 35,000 per month. Okay. And from January onwards, he has self-occupied it. And please remember, In this case, no unrealized rent, no vacancy rent is there, and hence unrealized rent is zero and vacancy rent is zero. Municipal taxes paid on the house property is 60,000 rupees for the full year, and interest on loan borrowed for construction of the house property was 1,20,000, and loan was borrowed on 1/10/2015 for 20 years. So loan is borrowed after 1/4/2019, sorry, 1/4/1999 for the construction of the house property, and hence a maximum ceiling of 2 lakh rupees is allowed. Let's do the problem. In such a case where a part, a part of the year it is self-occupied and the remaining part of the year it is let out. So as I already told, to assume that this particular house property is let out and you are denied of the benefit of section 23 subsection 2 and subsection A. Okay, let's do the problem, and we will assume we are supposed to do the problem as if the house property is been let out. So municipal value already given in the problem is 4,80,000 rupees. Fair rent is 4,20,000 rupees, and 6 lakhs is the standard rent. So here first you have the first step is the normal steps are followed. Step 1, step 2, step 3, step 4, and step 5. The first step is expected rent. So municipal value versus fair rent, whichever is highest is 4,80,000 rupees. Compare this one with 6 lakhs, and among them whichever is lower, and this is 4 lakh rupees. Now next one, and next one is section was step 2, sorry, step 2. What does step 2 speak? It is actual rent at which it has been let out, actual rent at which it has been let out minus unrealized rent. So it is already stated in the problem there is no unrealized rent, which is zero. So actual rent at which it has been let out is 35,000, as shown in the problem. 35,000 is 35,000 rupees. So 35,000 rupees. So 35,000 into 9 months, because 9 months it has been let out. So it is 3,15,000 rupees. So step 1 is there, step 2 is there. Unrealized rent is zero. So step 2 answer you got. Step 1 answer, and step 2 answer. Step 1 is expected rent 4,80,000 rupees. Step 2 is rent received or receivable 3,15,000 rupees. Step 3 is expected rent versus actual rent received or receivable, whichever is highest. So 4,80,000 versus 3,15,000, whichever is highest. So it is 4,80,000 rupees. Loss due to vacancy, as the house is not vacant for single single day also. So the loss due to vacancy is zero. Step 5 is step 3 minus step 4, which is 4,80,000 minus 0 is equal to 4,80,000 rupees. So you got now um, gross annual value of the house property. Now let's talk about the next step, how to calculate the income from house property. So gross when after this is the format, as I already told. Gross annual value is 4,80,000. Municipal taxes is 60,000 rupees. Now the net annual value is 4,20,000 rupees, because 4,80,000 minus 60,000 is equal to 4,20,000 rupees. So standard deduction. So there are some deductions under section 24. One is standard deduction at a rate of 30% on NAV, which is 4,20,000 into 30 percentage is equal to 1,26,000, and interest on borrowed capital is allowed to the extent of 1,20,000 rupees. So 4,20,000 minus 1,20,000 minus 1,26,000 will give that the income from the house property is 1,74,000 rupees. So this is the way in different situations, either it is situation 1, 2, 3, 4, or 5. This is the method, the normal expected way of solving the problem and determining and computing income from house property. Okay, now let's talk about some more situations. Now, Mr. S. Ramesh Kumar Mehta, let's take up a numerical problem and try to solve the problem. The problem is like this. Mr. Ramesh Kumar Mehta has got three houses, and the three houses are in Baroda. House number one, house number two, and house number three. Please remember this is a very, very important exam, and this can be expected in your examination. So house number one, house number two, house number three, the municipal valuation, the fair rent, the standard rents are given. The municipal valuation, the standard fair rent, the standard rent are given. The municipal taxes paid by him is also given. The interest on borrowed capital also is given, and the date of loan taken is not given, not required. Repairs, how much repairs are being carried out on this house property one, house property two, house property three are given, and insurance on the house properties are also given. Okay, and this data of 30,000, 40,000 is per month. Now, this guy is working in a company called as JSPM Rajashri Sahu College of Engineering with a salary income of 10 lakh rupees. He contributes to a premium of rupees 1 lakh towards LIC policy, and he also does a principal repayment of housing loan during the year to the extent of 2 lakh rupees. Okay, so this guy is working in a college where his income is salary income is 10 lakhs. Apart from the houses he has got some more income, and on top of it, he has taken a LIC policy, and on which he is paying a premium of 1 lakh rupees. And not only is paying the interest on borrowed capital, every year the bank is deducting principal repayment of housing loan. And this year the bank has deducted a principal amount of housing loan of rupees 2 lakhs. With this given data, you are supposed to find out income from house property, income from salary, any deductions, and gross total income. Gross total income. So before we start doing the problem, one note which we have to follow is this is the note, this is the hint to the problem. If you want to solve this problem, you should have an idea about this particular thing. What is that? Since Mr. S. Ramesh Kumar Mehta has occupied three house properties for residential purpose, according to law or income tax law, only one house property, according to the choice of the assessee will be treated as self-occupied, and the remaining two houses will be deemed to be let out. So what does it mean? It means that in this case, he has got this guy has got three houses A, B, C, and he's claiming that he's occupying this house properties. He's using for his own purpose. But rule says that he has to show only one as self-occupied, the other two as deemed to be let out, irrespective of the fact whether he's letting out or not. He can't state that he's residing on all the three houses. So he has to show one as self-occupied, the other two, and automatically other two will be deemed to be let out. The word is deemed to be let out. Now, this is according to his own choice, which one he wants to show as self-occupied and which one of the houses he wants to show as let out. Okay, let's do the problem. Now, how do we do it? Which one is to be self-occupied and which other two are to be deemed to be let out? Another circumstance can be like there are four houses A, B, C, D of Mr. S. Ramesh Kumar Mehta, and he's claiming that he's residing in all the houses. He's self-occupying in all the houses, but it can't be as such. What he has to do according to law, one he has to show as self-occupied, and the remaining three is deemed to be let out. And this is according to choice. Like if he can show this as self-occupied, this as other case two, this as self-occupied, case three, this as self-occupied, this as self-occupied. One sees showing this as self-occupied as his choice, the other three are deemed to be let out, so on and so forth. So this is the combination. Now let's do the problem and find out uh, how to solve the problem. So in this case, assuming that all the houses are let out. Now, the first step is in the first step, what you have to do, will assume that all the houses are been let out. And in the second case, okay. In the first case, we'll see that all the houses are let out, And the second step is we'll assume that the all houses are self-occupied, and then we'll find income from the house property. This is the steps we have to follow. The first step is I am assuming that the houses are self-occupied. The houses are self-occupied. Okay. Okay. Let's calculate. So for the houses which are self-occupied, we have to find out GAV. Step one. Step two is actual rent minus UR. Step three is step one versus step two, whichever is highest. Step two versus step one, whichever is highest, and then vacancy rent. Then all that step you remember very well. So the same methodology we'll find we use it to find out income from the properties if they are let out, and we are assuming they are deemed to be let out. So in the first case, the municipal value is 30,000, the fair rent is 40,000, and the standard rent is 50,000 in case of house number one. So this versus this, whichever is highest, and this is the highest. Compare this one with this one, whichever is lowest. So municipal value versus fair rent, whichever is highest, and whatever result you got, compare it with standard rent, whichever is lowest. So 40,000 is the expected rent. Annual rent is not given because he is claiming that it is self-occupied. Unrealized rent also is not given because it is self-occupied. So this is there is no data not applicable. So step two is not applicable. So automatically step one versus step two, whichever is highest is 4,80,000 rupees. Vacancy rent as is self-occupying, there is no question of sorry, as this is let out, but there is no data about loss due to vacancy, so it is assumed it is nil. So 4,80,000 minus 0 is 4,80,000. Second house property. Let's talk about. So this is the gross annual value of the first house property. So please remember this figure, very very important, because these figures will be used in further calculations. Next one is house number two. 40,000 is the fair rent, 40,000 is the municipal valuation, 40,000 is the standard rent. So among these two, whichever is lowest is 40,000. Compare this 40,000 with 40,000, which is standard rent, whichever is lower, and they are same. So 4,80,000 is the expected rent. And the figures as far as annual rent is not given, and hence it is not available. uh, this is step one is over. Step two is actual rent at which it has been let out minus unrealized rent. So this is not applicable. This is not applicable. Hence, step two is nil. So hope you have understood. Step three, step one versus step two, whichever is lowest, sorry, highest, and in this case, 4,80,000 rupees. Vacancy rent is not there. Loss due to vacancy is not given. So 4,80,000 minus 0 is 4,80,000. So this is the gross annual value of the house property 2. Now let's talk about gross annual value of the house property 3. Let's calculate it. Okay, let's do it. Now in the first case, in the third house property, the municipal valuation is for 50,000 rupees per month. The fair rate is 40,000 per month, and the standard is 45,000 per month. These two, whichever is highest, which is 50,000, compare this 50,000 with 45,000, whichever is lowest is 4 lakhs, sorry, 45,000. So this is the expected rent per month. So 45,000 into 12 is equal to 5,40,000, which is the expected rent. Step number one. Step number two is zero because there is no data of unrealized rent and annual rent. So step two answer is zero, nil. Step 1 versus step 2, whichever is highest is 5,40,000 rupees. There is no vacancy rent and it is assumed to be 0. So 5,40,000 minus 0 is 5,40,000. So gross annual value is 4,80,000, 4,80,000, 5,40,000 in case of house property 1, house property 2, and house property 3. Now, after we found out the house property 1, 2, 3 gross annual values, we have to find out from the given data using steps income from house property. income from house property. So I have carried forward this data 4,80,000 gross annual value, 4,80,000 and 5,40,000 rupees. Now municipal taxes. Municipal taxes is 20,000, 30,000 and 40,000 rupees. So 4,80,000, 4,80,000 minus 20,000 is equal to 4,60,000. House municipal taxes paid 4,80,000 minus 30,000 is equal to 4,50,000. And in the third case, 5,40,000 minus 40,000 is equal to 5 lakhs. Now standard deduction of 30% on NAV, which is 1,38,000, 1,35,000 and 1,50,000. And interest on borrowed capital, 1,50,000, 1 lakh and 1 lakhs, 1,20,000. So what we have done till so far, if the house property is let out during the year, then house property 1, house property 2 and house property 3, there is the income from house property of 1,62,000. In case of house number 2, it is 2,50,000. And in case of in property 3, the income from house property is 2,30,000 rupees. So this is the first step. The first step is you are assuming that the house properties are let out and you are finding out income from the house property. Now the second step is you have to assume that the house properties are self-occupied. So I told you the income from house property, if it is self-occupied, the gross annual value of such house properties are nil. So in either cases, as I am assuming that the house properties are self-occupied, the gross annual value is zero. So 0, 0 and 0. This is number one. Municipal taxes are 0, 0, 0. So 0 minus 0 is 0 in all the cases. Standard deduction of 30% on gross annual value, which is 0 in all the cases, is 0. Now last step, interest on borrowed capital. Yes, it is allowed as deduction. In the first case, interest on borrowed capital is 1.5 lakh rupees. In the second case, it is 1 lakh rupees, and in the third case, it is 1,20,000 rupees. So, because of this, what has happened? The loss from income house property A, house number 1, house number 2, and house number 3 is 1.5 lakh rupees, 1 lakh rupees, and 1,20,000 rupees. So, the first two steps are over. What are the first two steps? All three houses were deemed to be let out, and I found out income from the house property. This is number one. Step number two is I assume that the house properties are self-occupied, and I found out the income from house properties. So this is what were done in the previous steps. One, step two, step three. Step three is you have to build a matrix like this. You have to build a matrix like this, and the matrix, the columns and the situation should be uh, written exactly. So this is the particular house number 1, house number 2 and house number 3. Okay, so you write house number 1, house number 2 and house number 3, and in the topmost column or row, in each column write case 1, case 2 and case 3. Now what is this case 1? Case 1 is, this is case 1, this is case 1, this is case 2 and this is case 3. Very very important. Again I am telling you, this matrix is very very important. If you have understood this matrix, you have understood everything. So what is this? So here in this case, house number 1, house number 2 and house number 3 is written in the like this, and case 1, case 2, case 3 are written like this. So this is case 1, this is case 2 and this is case 3. So what is case 1? The case 1 is house number 1 is self occupied and house number 2 is let out and house number 3 is let out. That is what is expected. How one is self occupied, the other other are deemed to be let out. So house number 1 is self occupied and house number 2, 3 are deemed to be let out. This is case number one. Case number two is house number two is self-occupied and the other one and three are deemed to be let out. So look horizontally. These are all self-occupied and automatically these are the remainings are let out. So hope you have understood this matrix. Now case three. What is case three? The case three is case one is house one is self-occupied. Case two is house two is self-occupied. Case three is automatically case three is house number three is self-occupied and the other two are let out. This can be one way of representing the matrix. The other way is the change the columns. So here I took case one. Sorry, here I took houses here and cases here, or you can take like this also. Cases here, cases here, and houses here. So it doesn't make any difference. So when I'm writing case one here, case two here, case three, case one is house number one is self-occupied, and the other two are let out. Case two is self occupied is a house two and the other two are self occupied. Case three is this one. Case three is house number three self occupied, the other two are let out. So let's do the problem now. Step number three. Step number three is so I am using this matrix now. I am using the matrix of houses here and cases here. Okay. So this is the summary. Before we go into the solution, let's take the summary. When the houses were, so you remember when all the houses were let out, we found out the income from a house property were 1,62,000, 2,15,000, and 2,30,000. You remember? Okay, I will show you. These were 6 lakh, 1,62,000. When they were let out, income from house property 1,62,000, 2,15,000, and 2,30,000. So I have written here. 1 lakh 62,000, 2 lakh 15,000, and 2 lakh 30,000. When they were self-occupied, these were the self-occupied incomes. When they were self-occupied, what were their incomes? These were losses. These were losses. I have written here losses. If you look, so how much was the loss? It was 1 lakh 50,000. If you remember, 1 lakh 50,000, 1 lakh, and 1 lakh 20,000. So the same way, I have just wrote the summary. I have just wrote the summary if the house properties are self-occupied and when the houses are let out in all the cases one, that is house number one, house number two, and house number three. Now go to the matrix. Next is matrix. So what is the matrix? The matrix is cases are written here and houses are written here. So what is case one? The house one is self-occupied and the other three are let out. Sorry, other two are let out. What is case two? Case 2 is house number 2 is self-occupied and other two are let out. Case number 3 is the third house is self-occupied and the other two houses are let out. So let's go further and discuss. Now what is happening? Let's look at the case 1. Case 1 is house number 1 is self-occupied. House number 2 is let out. House number 3 is let out. So house number 1 is self-occupied. I told you. So look at this. 1,50,000 here, 2,50,000 here, and 2,30,000 here. 1,50,000, 2,15,000, and 2,30,000. Next one is house number 2 is self-occupied. House number 1 is let out. House number 3 is let out. So look at this. 1 lakh is self-occupied. 1,62,000 is let out, and 2,30,000 is let out. So I have done that. So similarly do for this. So you will get the answer to this like this. Now case number 1. 1,50,000 is the loss from the first house. 2,15,000 is the profit, and 2,30,000 is the profit. So what is the case 1 income? Case 1 income is 2,30,000 plus 2,15,000 minus 15,000, 1,50,000, sorry, is equal to the income in case of one is house number 1 is self-occupied and house number 2 is deemed to be let out and house number 3 is deemed to be let out is 2,95,000 rupees. Now case number 2. is self-occupied. When you are self-occupying the house property, the loss is 1,10,000. I have written here. When it is let out, the income is 1,62,000, and house property 3 is 2,30,000. So I have written here. So total it. Case 2, income is 1,62,000, loss is 1 lakh, and income is 2,30,000. So 1,62,000 plus minus 1 lakh plus 2,30,000 is equal to 2,90,000. Similarly, for case 3 also, deemed to be let out, then income is 1,62,000. Deemed to be let out, house property 2, income is 2,15,000, and self-occupied, because case 3 says that house number 3 is self-occupied. So you will get income or loss of 1,20,000. So income is 1,62,000 plus 2,15,000 minus 1,20,000 is equal to 2,57,000. So you got this case 1 income this much, case 2 income this much, case 3 income this much. So obviously any human being on this earth wants to show less income, and hence he will show this situation. What is the situation? The situation is house number 3 is self-occupied and house number 1 and 2 are deemed to be let out. So this is the way you can solve the problem. Hope you have understood. Now I'm going to stop and take up the questions if any, and thank you so much for patience listening.